Ultimate House of Cards, the hidden $5.1 trillion debt bomb. Hey everyone, Felix here. Today we're diving into something most commentators aren't willing to focus on, a hidden debt bomb, estimated at $5.1 trillion or more, that could dwarf even the 2008 global financial crisis. You've heard of the 2008 meltdown. But what if the next crash is built on something far more sinister, far less visible, and far more dangerous? Let's dig in. Let's start with what we do know. In 2008, the collapse of the US housing bubble triggered bank failures, massive bailouts, economic shockwaves globally. But what if the next house of cards isn't housing, at least, not directly, but instead lies in the murky world of hidden debt, leveraged exposures, interconnected liabilities, predatory lending, governments on the hook, off-balance sheet skullduggery? According to the channel this week, the claim is that this hidden debt, or debt bomb, may total around $5.1 trillion. That number is staggering. If true, it raises the question, how prepared are we for the fallout? Here's the problem. Many of these obligations are not front and center on balance sheets. They might be contingent liabilities, guarantee structures, off-balance sheet vehicles, or complex derivatives. When the music stops, these hidden obligations can snap. And unlike 2008, where at least many exposures were out in the open, many of these are buried. So how did we get here? A few factors. 1. Government debt and guarantees. In the wake of multiple crises, 2008, pandemic, supply chain shocks, governments borrowed at record levels. Guarantees, backstops, contingent liabilities, like bailouts, expanded. 2. Corporate leverage and non-bank financial system. Banks may be regulated, but a lot of financial plumbing now sits outside traditional banks, shadow banks, special purpose vehicles, securitizations. These carry risks often less transparent. 3. Interconnected financial system. One failure can propagate. Think counterparty exposures, derivatives, rating downgrades, liquidity crunches. 4. Complacency and opacity. Many investors assume this time is different, or that central banks have everything under control. But hidden debt thrives in the blind spots. Let's walk through three major zones of risk. Zone 1, government and sovereign guarantees. When governments guarantee loans, bail out industries, or stand behind large infrastructure projects, they are taking on off-balance sheet risks. If the project fails, or the industry collapses, the government becomes liable. We've seen this in past crises. But now the scale is enormous. The accumulation of these contingent obligations may not show up cleanly in the headline, national debt, number, but they're there. If one big country or region hits trouble, the contagion may spread. Zone 2, corporate and non-bank leveraging. We often hear about corporate debt levels in the US, China, etc., but the more subtle danger is in the non-bank financial system. Hedge funds, private equity, structured finance vehicles, special purpose vehicles, SPVs, taking on leverage. When those leverage bubbles collapse, the assets may be illiquid, prices may collapse, and the losses may ricochet into banks, pension funds, sovereign wealth funds. In other words, a company failure could be small to the company itself, but huge to the system. Zone 3, shadow finance and interconnected derivatives. This is the plumbing. Derivative contracts, leveraged exposures, counterparty risks, systemic linkages. Many of these are hidden or opaque. When one large player defaults, the counterparty losses may trigger margin calls, forced liquidations, etc. The system is like a web, and many of the threads are invisible until they snap. Now, you may ask, why is nobody screaming about this? A few reasons. Because the risks are not obvious. They're hidden. Because official statistics may underreport or mask the full picture. Contingent liabilities, off-balance sheet vehicles. Because there's a prevailing belief, central banks will save the system, we'll never have a meltdown like 2008 again, regulation is stronger now. But those beliefs may be dangerous comfort. Because markets are chasing yield, complacency reigns, and risk is underpriced. Let's look at a scenario. Imagine a large leveraged non-bank institution in country X collapses, due to real estate bust, liquidity crunch, etc. It owes huge amounts in derivatives to banks globally. The banks begin to suffer losses. Governments step in to guarantee or bail out. But the guarantee is so large, bigger than expected, that the government's fiscal position deteriorates. Credit rating is downgraded. Borrowing cost rises. The government enters a debt spiral. Investors panic, markets crash. Sound familiar? Yes, like 2008, but bigger. The difference, this time the exposures may be far larger and less transparent. The trigger might not be housing, though it could be, but could be something else: infrastructure bust, sovereign debt shock, shadow bank collapse. So, what can you or I do about this? What should we watch? What are the red flags? I'll list some key warning signs. Red flag 1. Elevated debt levels plus weak growth. When debt is rising fast but growth is slow, servicing costs absorb more of revenue and margins thin. Red flag 2. Sharp increase in non-bank financial intermediation. When huge funding is coming from non-bank sources, funds, SPVs, obscure structures, risks multiply because oversight is weaker. Red flag 3. Contingent liabilities growing. Governments guaranteeing large projects or industries, or taking on implicit guarantees without reflecting them in official stats. Red flag 4. Liquidity stress in safe assets. When assets thought to be safe, government bonds, high-grade corporates, begin to show signs of illiquidity or volatility, the safe haven assumption breaks. Red flag 5. Rapid credit rating downgrades plus rising spreads. When investors demand higher compensation for risk, or governments, large corporates get downgraded, that increases costs, causes feedback loops. For investors, if you're watching for your own portfolio, diversify, don't assume everything is safe. Maintain liquidity, because if the next crisis hits, you may want dry powder. Monitor counterparty risk, not just the visible exposures but the hidden ones. Consider safe haven assets, but even these may suffer if the crisis is systemic. Stay alert to global linkages, one small shock somewhere can ripple worldwide. Now let's address a few counter-arguments you'll inevitably hear. Counter-argument 1. This time is different. Regulation is stronger, banks are safer. Response. True that banks are better capitalized in some jurisdictions, but many of the risks are now outside regulated banking, in shadow finance, guarantees, derivatives. Regulation has not eliminated systemic risk, it has often shifted it. Counter-argument 2. Central banks will just print money, bail everyone out. Response. Yes, they might try. But there's a cost: inflation, currency debasement, loss of credibility, social unrest. Also, central banks may be constrained by politics, debt, and global capital flows. Counter-argument 3. $5.1 trillion is exaggerated. Response. Maybe. But even if the number is half it, say $2 minus $3 trillion of hidden risk, it's still enormous. The point is not just the number, but the structure of risk, and the lack of transparency. So ignoring it because we don't know exactly is dangerous. Let me leave you with this. We're living in a world of loose monetary policy, big government debt, global interconnected finance, shadow finance growth, and complacent markets. The next crisis might not announce itself with a loud headline. It might creep up via the hidden channels, the off-balance sheet exposures, the underappreciated guarantees. When it comes, it could be bigger than 2008, because we built the next tower of cards on top of the last one. If you're an investor, protect yourself. Educate yourself. Don't rely solely on mainstream reassuring narratives. If you're a citizen, question your government's liabilities, ask who is guaranteeing what, ask how safe the system really is. Because when the next crash hits, and it might, you'll want to be ahead of the crowd, not scrambling behind it. Key takeaways: hidden debt of possibly $5.1 trillion is a major systemic risk. Much of it resides in off-balance sheet, contingent liabilities, non-bank financial system. The next crisis could be triggered by something different than 2008, but still get just as destructive, if not more. Red flags abound: high debt with weak growth, shadow finance expansion, rising guarantees, illiquidity in safe assets, worsening credit spreads. You can't control everything, but you can prepare. Thanks for watching. If you found this video helpful, hit the like button, subscribe if you haven't already. I'll be doing deeper dives into these risk zones in coming videos, for example, the shadow bank system, derivatives exposures, sovereign guarantee traps. And I'd love to hear from you. Drop in the comments, what worries you most in the global financial system? Have you seen another big, hidden risk that people aren't talking about? Let's get the conversation going. Stay alert. Stay informed. This is Felix. See you next time.